Okay, so let me show you two pictures today which will blow your mind. Okay, so here is picture number one, and this is what it says. It says that what has been the highest increase in the gold prices in one single year. That is what the question means. So it says that the gold prices have risen from 2010 to 2011. At what rate? It increased from rupees 18,500 per 10 grams to 26,400 per 10 grams. So in 1 year, gold gave how much return? 42% return approximately. Mind blown. Now you would say, hey Akshat, gold is the best asset in which we can invest, and let me put all my money in gold. Hold on for a minute. This is what we are going to discuss on today's video. Let me now show you the second picture. Now this is a very interesting article, very interesting picture. Now this outlines the amount of gold that Indian women have. My mom is also included in it. Give a big thumbs up for her. If your mom is included, do comment and tell me in the comment section that if your mom holds gold or not. So Indian women are holding 21,733 tons of gold, which is 11% of gold held by females across the world. So this is a very interesting fact. We used to say that India was Sone ki chidiya. It is still Sone ki chidiya in one segment of the population. So on this video, I'm going to help you understand three things. One is that I'm going to help you understand gold as an investment asset class. What are some of the key trends in gold prices? How does gold prices move? What are some of the cues that you should look at? Second, I'm going to discuss some investment options, not all investment options, but some major investment options that you and I as an investor have when we are looking to invest our money in gold, and which of it is the best option class where you can invest. Third and finally, I'm going to tell you my strategy of investing in gold, whether I'm an investor in gold or whether I'm investing in some other alternate asset. So we will have this discussion. Please stay till the very end of the video, because at the end of the video, I'm going to show you something really cool, right? I'm going to show you and talk about an asset which in my opinion will give more returns than gold. It is somewhat similar to gold, but in my opinion, it will give you higher returns than gold. So let's get this video started. Now let me first show you the historic prices of gold, and let me take you through the history of gold, so to say, from a pricing perspective. Now the first thing that you will observe that there were major dips in the world that we are all aware of. For example, we are aware of the 2000, almost 2000 or 90s bubble. So it crashed somewhere here. We are also aware of what? 2008 financial crisis. We are also aware of what? We are also aware of the 2020 Corona hit, right? Now what do you observe? That every time there was a major crash, the prices of gold increased. It increased here, and it kept on going up. Then it increased again, right? Now based on this brief discussion, what is it that you notice? You notice that the world is safe. Everything is going hunky-dory, the gold prices hardly move, right? For example, we had a relatively decent bull run up until 2016, 2017 in the market, and the gold prices went down during this time. Again, we had relatively good growth in the 90s, and the gold prices stayed flat or they came down. So the point I'm trying to drive home is very simple, that point number one, whenever the world's economy does well, gold prices tend to stay flat or they fall. That's point one. Second point is that after a crash, the gold prices generally move up. Now, why does that happen? That's a very interesting question. And if you're a beginner in economics, you would understand that there are different asset classes, right? So asset classes would be things like, for example, stocks. So stocks is an asset class. Similarly, if you're looking at bonds, then bond is an asset class. Similarly, if you look at real estate is an asset class. Similarly, commodities, right? Commodities are an asset class. So within commodities, we will have stuff like gold, silver, bronze, oil, right? So all these are asset classes. Now what happens is that whenever there is a shock to the economy, whenever bad things happen, for example, in 2020, coronavirus hit. The economy took a slump. India's GDP went down, generally the way Zimbabwe's economy used to go down under Robert Mugabe. So the point is that whenever bad stuff happens in the economy, what happens? The money flows from stock market, bond market to commodities, right? Especially to safe commodities, right? Now, what is the measure of safety? Literally, the measure of safety is gold. If you actually go and speak with my mom and ask her, like, hey Akshat's mom, what do you think is the best asset in the world? My mom will say gold, because there is a safety associated with gold. We all feel safe and secure when we are buying gold. So there is a lot of money that flows from stock market to gold market during times of distress, right? Because gold is an indicator of safety. So please remember this central point. So whenever you are trying to buy gold, buy it during a crash or near a crash. Now you would say that, you know what, Akshat, during a crash, for example, when 90s.com bubble burst, when 2008 bubble burst, when 2020 coronavirus pandemic hit, those events happen and then gold prices literally shoot up, right? They shoot up like this, they shoot up like this, they shoot up like this. So if I'm buying gold during a crash, should I do it? Because everyone would be buying it. Yes, the idea is to look at certain data points, right, and try to predict when the crash is going to happen. And a good data point would be to track the unemployment rate, right? Because unemployment rate act as a precursor to a falling economy. For example, just before the 2008 crash, unemployment levels were relatively high. So it indicates that there is something weird that is going on in the economy. So keep a track of unemployment rate and try to guesstimate the price of gold from that angle. This is the first key tip. Now another indicator is shrinking GDP. Right? Another indicator for increasing gold price would be shrinking GDP. If you see a period where the GDP has been shrinking constantly, then it could be an indicator that the gold prices might become a rocket. So keep an eye out for these two indicators. This is very important. Then accordingly, make the decision of buying gold. If everything is going hunky-dory in the economy and you are trying to buy more and more gold, it's probably pointless. Please don't do it at that juncture. You will not make a lot of returns. Now the second point is that gold prices are very difficult. I'm not saying just difficult. They are very, very difficult to predict. Why am I saying it? Do you see the fluctuations? There is like so much fluctuation in gold. There is just no one single factor that determines the gold prices. Many times people say that, you know what, if the US dollar is getting weak, then gold is getting stronger. Yes, but there are new forms of investment that come up very frequently. For example, now we have Bitcoin. So if US dollar is getting weakened, people might buy Bitcoin over gold, right? So that type of stuff also happens. These are all just indicators. That is all you need to keep in mind. There is no one fixed way of predicting gold prices. If you could perfectly predict it, of course you are going to become a billionaire. No one can predict gold prices correctly. You can just look at various indicators and try to estimate. Now this brings us to the third point, and you might ask me that, hey Akshat, this looks super complex. So what exactly is gold price dependent on? So of course we can't predict what exactly it is dependent on, but what determines the gold price is again our fancy equation called as demand and supply. So supply side is upward sloping, demand curve is downward sloping. Wherever this supply and demand meets, the gold prices move, right? So this is the basic concept in economics that you need to understand, that every asset price is dependent on supply and demand. Now, why am I telling you this concept? So let's understand it by using a simple example, right? So let's look at US dollars, let's look at gold, and let's look at Bitcoin, right? So three asset classes. Now, previously what used to happen was that if the US dollar is struggling and people feel jittery that, you know what, US dollar might crash, then more money will be moved into gold. Now what will happen? The demand will increase for gold and the prices will go up, right? So the demand will come here, right? And the prices will be here. So prices will move up. Why? Because people are buying more gold over US dollars. But now let's imagine a scenario that Bitcoin also comes into the equation. Even if people feel that US dollar is struggling, they don't necessarily need to move their money to gold. They have other options or other alternate asset class like Bitcoin. They might feel that the real estate market is undervalued, so they might move their money there. So a lot of things can happen. Therefore, it's very difficult to take these macroeconomic indicators and try to predict it. I have talked about the unemployment rate. I particularly feel that that's a good measure of predicting gold prices. That's a second point. And the last point that I will talk on this chart is that gold prices are cyclical, right? So you will see these phases, right? That, hey, during this time period, gold did not move. Then it ran. So it ran for like almost from 2004 to 2012, right? Then it fell. So it fell from 2012 to 2016. It kept on falling. Now it's going up from 2016 to 20. It came down after the coronavirus pandemic got stabilized somewhat, a little stabilized, and now it's fluctuating. So these have like long cycles, right? Long cycles. This is very, very important. First there is like stability, then increase and decrease. Now it's increasing. So just by looking at this trend, if you make me bet my money whether the gold prices will go up, down, or stay flat, I would say that it would mostly stay flat. Why? Because there has been a massive cycle here that has happened where the gold prices have gone down, and there has been a massive cycle where it has gone up, right? So for the last 4 years, generally the gold prices have been up. So we are very much ahead in this gold cycle. So I would rather not put my money in gold as of now. Now you say that, hey Akshat, that is fine if you're not investing in gold, but can you still discuss some options that we could consider if we are interested in investing in gold, and what asset are you going to invest in? So wait for that till the end of the video, I will reveal. But let's quickly discuss some of the options that you have in terms of buying gold. And I will give you practical real world realities here, and I will not give you theoretical gyan. So the first key way in which you can buy gold is that you can go to your jeweler or sonar and you can buy physical gold from them. Now, what is the advantage? The advantage is that you can feel the gold, right? You can sleep with your gold. You can keep your gold under your pillow. You will probably get like good night's sleep. I don't know. But bottom line is that you can feel and touch, and you will feel that safety that yeah, I'm holding gold, right? Now, if we talk about the risks or disadvantages of buying physical gold, there are numerous problems. First and foremost, you would always question the genuinity of the gold. It's very difficult to test the genuineness of the gold, especially when you're buying it from a jeweler that you don't know. So please buy from trusted jewelers only. That's point one. I also went to something like Tanishq. In fact, I did not go. I don't spend much money, but my wife went to Tanishq. And there we got some of our gold jewelries tested, right? Luckily, they were original. So what I'm trying to tell you is that if you have physical gold, you can go to Tanishq and these big jewelers, and they have these testing machines. So get your gold tested also. That will give you that peace of mind that whatever gold you are holding, it is actually genuine. So this is the first key problem that you will face, that you will have hard time trusting your jeweler. So please make sure that you take some precautions here, get it tested from multiple people, only then agree to that deal. Or if you have purchased from a jeweler, then go and get it tested from some other jeweler very quickly. So this is point one. Now a sub point here is very simple, that if you are buying physical gold, then try to buy it from a non-jewelry perspective, from an investment point of view. I have heard this argument, again calling on my mom, I think she's going to kill me. But the bottom line is that my mom always believes that, hey, if we buy jewelry in gold format, gold prices will go up, and then you know what, you can sell it. Okay, here's the problem with that argument, that gold jewelries have a lot of making charges, lot of commissions, right? Which brings us to the second point regarding physical gold, that if you're trying to sell that piece of brick of gold, right? If you have a small brick of gold, you're trying to sell it, there will be no making charges on it, but you will have to pay commissions both at the time of buying and selling to your jeweler. If you have a jewelry, then you will pay what? You will pay commissions also, plus you will pay making charges also, and probably breaking charges also. So a lot of headache in terms of owning physical jewelry. Now there are certain points, for example, robbery can happen, and I might lose my gold chain, all that stuff, security related, of course that is there. So please be aware of all these basic points before you buy physical gold. Then you might say, hey, Akshat, you know what, should I never then buy physical gold? It depends, right? Now if you are someone who is earning in white cash, and if you go to a job, you get salary directly in your bank account, please don't buy physical gold. No, it is pretty much pointless. If you have black money, then of course, I'm not like an expert in terms of handling black money. I don't make black money to begin with. All my businesses are digital. So if you are getting black money, then of course you need to store it, right? Rather than storing it in physical form of cash. If you can get somehow to buy gold, go buy it, right? So this style of physical gold investing is good for people who have a lot of black cash. Okay, then what about people who have jobs? In which type of asset should they invest? Should they invest in sovereign gold bonds? Now this is such a heavy word and it is so misconstrued sometimes. So essentially, sovereign gold bonds are bonds that are issued by the sovereign. Sovereign means a country's government. And gold bonds, so these are gold denominated bonds. There is equity, which is stocks and bonds. So sovereign gold bond means what? It means that it is a gold bond market, which has been issued by a government, right? So the government will say that, hey, we are launching this gold bond. You pay us money. For example, I pay government 25,000 that I'm going to invest in your sovereign gold bond scheme. Government will take that money and go and invest that money in some gold assets. And along the way, they will keep giving me some returns for the money that I have put with them. So this is a simplified way on how sovereign gold bonds work. Now let me take you through how Indian sovereign gold bond works. So there is a specific scheme. These sovereign gold bonds are released by RBI and there are different tranches under which that they release and they make the offers really attractive. So here is a chart for you. Please take a look at it. And there are some key things or some key benefits that they are stating. So the first key benefit is that, hey, you can make like 2.5% return. Oh my God, I'm rich. I'm impressed by this 2.5%. In FDs only you make like 6%. So this 2.5% is pretty much pointless. That's one. Second is that, of course, you don't have to secure gold and store and all that headache. Valid point. Third, liquidity is tradable on an exchange. It means that you can go and sell your bond, right? And it's liquid because there are a lot of buyers for this bond. Okay, makes sense. This is a good advantage. There is no GST and making charges like physical gold. Okay, they are taking a jab at jewelers. Okay, good. This makes sense. It can also be used for collaterals for loans. If you have to take home loans, then your credit worthiness can be assessed by these gold bonds. Now, there is no capital gains tax on redemption. Okay, amazing. Now, government has said a lot of good things. So let me explain a couple of negative things also. One is that this is a bond. So bond means that your money gets locked in. So when I purchased this gold bond from the government, I invested 25,000 in it, right? Now that money gets locked in for a certain period of time, let's say 5 years. Now if I break that bond, now I'll be paying penalty on it. That's one headache. Now the maturity of these bonds is long term, fairly long term. For example, in sovereign gold bonds case, the maturity period is 8 years. Now what happens is that let's say that you purchased the bond in somewhere in, let's say, August 2020, right? Now you will get your money in August 2028, right? Now the gold prices could be trading anywhere, right? It could be going up, down, center, right? Now if the gold prices are flat or it has gone down temporarily, then you will take a hit at the time of maturity, because when you get paid as per the last 3 days trading price. Now this is what was written on RBI's website, that on maturity the gold bond shall be redeemed in INR and the redemption price shall be based on simple average of closing price of gold 999 purity of last 3 business days, right? So whatever the trading price for the last 3 business days is, they will take an average and give you the money in equivalent form. So to cut this long discussion short, they have given like a lot of hooplas that you will save tax, you will do this, you will give 2.5% return, you will save GST. Okay, all this hoopla is pretty much pointless if you're an aggressive or a moderate investor. Why? Because this 2.5% rate of interest is not very attractive to begin with. That's one. Second point is that your redemption amount depends on what? It depends on the gold price. Now gold prices are very hard to predict. So therefore you can invest your money in better assets which are more liquid. Now why am I calling sovereign gold bonds less liquid? Because there is a 5-year lock-in period. So you will get locked in unnecessarily. Now if the gold price is not moving, you are not breaking your bond, because you will say that, you know what, if I break my bond, then I'll have to pay the government money. I don't like paying government the money, I'm like Akshat. Then you will not break your bond. Then you will keep taking the hit in terms of pricing. So there are much better options available in my opinion. And let me discuss 2 options here. Now before I walk into these options, there is a very quick summary that I like to give you here. See, you make money by investing in gold. Simply, all that analysis, theory, keep it separate. You make money in gold only if gold prices are going up. Now, if you have invested in sovereign gold bond, it's fine. If you have invested in gold ETF, it's fine. You can invest in whatever asset which is gold backed. You will only make money if the gold prices are going up. So please revisit the first section and try to estimate when the gold prices are going to go up, sideways or down, and accordingly invest in these different instruments. Now let's move on to third option, which is called as gold exchange traded fund, ETFs, right? Now these ETFs, exchange traded funds. So funds are what? Mutual funds, right? So the way you do SIPs in some equity or large cap or small cap fund, similarly you can do investment in an ETF which is gold backed, right? So there are a lot of companies that offer these type of gold mutual funds, so to say. So there is Invesco, there is Nippon India, there is HDFC Gold, there is ICICI Prudential, there is IDBI Gold Exchange Traded Fund. So there are a bunch of companies that offer this exchange traded fund that take your money. If you give them money, they pick it up and invest in gold focused assets. Now this sounds really good in theory that, you know what, mutual funds, very similar. I can invest in gold, make money. So it would be useful to take a look at how IDBI Gold Exchange Traded Fund has been doing, and this would be the similar performance for almost all gold backed ETFs. So in 1 month, it has given 1.57 negative return. In 6 months, it has given 4% return, which is more than an FD, so it is good. In 1 year, it has given negative 10% return almost. In 3 years, it has given 15% annualized return, which is amazing. In 5 years, it has given 7.76% return, not that great, okay. So what do you observe from this? You observe that number one, that gold prices are extremely cyclical. Only if you have the stomach to hold your gold assets for a very long time, don't get into that cycle, because you might get caught up in a bad cycle. You will see negative 10% return on it. You will feel dejected, and then you will move your money and pull away money and you will take a loss. So don't do it. Invest the money that you have in gold that you want to invest for a long term. Now this brings us to the fourth asset class in which you can make gold investment, and these are gold loan companies. Now you would have seen Mr. Khiladi Akshay Kumar doing several advertisements for gold loan companies. So these are companies like Muthoot Finance or Manappuram Finance. These are pure businesses. These are companies. So you need to analyze these stocks like you analyze different companies. You should only invest your money in these companies if you understand, number one, the cyclicity of gold. That's one. So we have been talking about it, that how gold prices go up and down. That's the first key point that you need to understand. And second key point is that you need to understand these businesses from an operation side. So let me quickly explain this point by taking the example of Muthoot Finance. Now here is a picture that you can take a look at. It mentions that George Alexander, who is the MD of Muthoot Finance, he says that 90% of Muthoot Finance assets are in gold loans now. So how will Muthoot Finance share price move, or why will it move? A, if there are gold price fluctuations, if the gold prices go up, their assets for Muthoot Finance will go up and the share prices will effectively indicate this. This is the first way Muthoot Finance stocks are going to go up. Second is that if there are good things happening in Muthoot Finance, for example, if they are able to expand their market presence, if they are able to take businesses from other, if they are able to lower their operating cost, improve their return on capital employed, all these good business related things happen with Muthoot Finance, their share prices will go up. Similarly, if something bad happens with Muthoot Finance management, then Muthoot Finance stock will come down even if gold prices are going up. So please understand that this fourth option which I am discussing with you, it involves analyzing what? It involves analyzing, number one, the gold cycle, whether the gold prices will go up or down, and the business analysis of these different gold loan giving companies. So analyze both and make investment. This investment option is for slightly higher advanced investors. If you don't know investing, please don't go and invest in this. Now just to summarize, and I will show you my investment option also. Investing in gold is a function of you having certain types of skill set and the type of investor you are. If you are a very basic investor, if you are like my mom, right, who just wants to make a little bit of money from gold, I don't want to take too much risk, go and invest where? Go and invest in sovereign gold bonds. Done, right? You'll get 2.5% guaranteed return and it's safe, right? It's safe. That's one. Second, if you're a moderate risk investor that, hey, you know what, I want to experience the cycle of gold. If it goes up, I want to massively benefit from it. But if it goes down, I'm okay taking the loss too. If you're that type of an investor, invest where? You should invest in exchange traded funds. Now comes the third category. You will say that, hey, Akshat, I'm an aggressive investor. I understand business. I know how I can do business analysis. I have been watching your videos. I have been pressing the like button on your videos and I have made notes out of your videos. So where should I go and invest? You could invest in gold loan giving companies like Muthoot Finance. Now finally, the question is that, hey Akshat, where will you invest? Will you invest in gold? Short answer is no, absolutely not. Then where is it that you're going to invest? I'm going to invest in Bitcoins. Now many of you would argue that, you know what, Akshat, gold has a lot of value, Bitcoin does not have intrinsic value. So here is a video that I had done. Please go and watch it and leave your comment that what according to you has more intrinsic value. Is it Bitcoin or cryptocurrencies like Ethereum, or is it gold? I would love to read your response and I will see you the next time. Till then, bye bye.